Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market Site, we have Chris Dearborn and Maddie Radner on the Nasdaq Market Intelligence Desk, as well as Arnim Holzer, Global Macro Strategist at Easterly EAB. We're here to discuss how the investment environment is changing and why portfolios and investors need to evolve with it. It is great to see you, everyone, as always. Arnim, welcome back to the show. Let's discuss Q2 earnings. What were your key takeaways?
Well, I think first of all, thanks for having me on the show. I think first of all, the earnings story is still pretty good. We're seeing tech lead, and in fact, we probably saw a little more predominance, a little more domination from the big tech names because frankly, the disruption is still there. The question is, are the valuations right? Will productivity stay in place? And are we getting to a place where there's going to be some fatigue at these levels? And I think what you're beginning to see this week, even though the Fed may do 25 basis points, which I think is pretty much in the bag, there is a concern about valuation, and there's a concern about whether this story has the legs to get through the impact of tariffs. And that's a very reasonable story. It doesn't necessarily mean that the market isn't where you want to be, but it tells you that the substrate of volatility, the heat coming out of this equation, is going to be a little different than it's been the first half of the year.
You could also make the argument there's a little bit of seasonality in here as well.
Absolutely, and in my note from a couple weeks ago, we talked about seasonality, and seasonality is there for a very good reason. There's obviously a Fed gap, and there's always this issue between what do the next 2 quarters look like in terms of earnings. The beginning of the year starts kind of slow, and so people get excited as earnings momentum builds, but then you start looking at, okay, what's the next 6 to 9 months look like? And so there's a natural reason to become a little more cautious.
Yeah, and Chris, as we're trying to discern if these tariffs are going to be passed down and how it's going to impact the consumer. So you need another quarter or two to be able to get some context around that.
Yeah, but the problem is that the tariffs keep getting punted. And so you don't know what the impact is going to be. Look at all the consumer names that withdrew guidance, in last quarter, May, June, and they're still afraid to put them back on because we just don't know. You've got a lot of tariffs coming on. The de minimis trade is supposed to unwind on the 28th. That could impact a number of consumer products. $800 or more, there's no tax, so that could be 30, 40, 50% on top of it. So there's too many unknowns, and then negotiations continue to happen with all the different countries. India's been hit again, because of the Russian oil and everything else, 50% and another 50%. So you don't know. When you're trying to model out, you don't know what your cash flow is going to be. It's impossible for analysts and really next to impossible for corporates to model out that business. So as a consumer comes, you see a lot of the people trading down because they're unsure. They're saving more, a little bit. Lower end income is, as we've spoken about multiple times, is doing without, doing buy now, pay later, trading down to either brand names, off-brand names, or just not doing. And that's a big concern. On the higher end, they're still spending. And that's what's carrying this forward on the consumer spend for the country. Right now, it's 2/3 of GDP. So you really don't know where people are because the data cannot tell you and model out.
Yeah.
And that's the problem.
And as we look at earnings season so far, companies have seen minimal margin pressure so far. And that's kind of what Chris was saying. It's because the tariffs have been punted. So have companies been able to find ways to sustain margins, or has the whole picture not really come to fruition yet? Have they not really had to figure out how to mitigate these tariff impacts? And this is kind of what we saw at the beginning of the quarter. Analysts really set the bar low. They aggressively cut estimates. They expected growth of 5%, but we've seen earnings over 11% year over year now.
Yeah, I think, and Maddie, we've had a number of guests on. You in particular have joined me for these where they're consumer data provider companies, and to Chris's point, it's how they're spending and where their debt load is. And I think that's a more detailed picture than consumer sentiment that we get.
Yeah, and I think that will continue to play out in really getting a sense of how consumers are spending. Are they using more credit? Are they delaying their payments? We don't know how that's going to play out yet, but hopefully that will give us more.
And to the point, wage increases are slowing, and we are seeing some delaying, as we were talking about, in terms of repayment, right, on the lower tier on the credit side. So there does look to still be this divergence, this two-speed economy. And the question that we have is, are you going to see enough of a productivity increase? And we talked about this before. The productivity issue is really a key issue. Are we going to continue to see from tech, software, and potentially AI enough of a bump that companies can continue taking some of that margin hit? Now, the data I've seen is very confusing. It's unclear to me whether companies are actually taking 20 or 30% of this in margin, whether the sellers abroad are taking 20 or 30%. It seems like some of that has been happening. Is there a stamina to continue to do that? It's unclear. In the middle of this, and I think this is kind of a key message for the advisors that we talk to and investors, volatility has really come in quite a bit. Now, the futures curve tells you that in November, December, the futures curve is still kind of high on the VIX. So I think everyone realizes that's what this kind of third, fourth quarter issue is, because the front end of the VIX has really come in, and the dispersion trade, which is a little wonky, you have a lot of selling of index vol to buy single stock vol. And as a result, implied correlation is very low. Today it's 12, but it's been as low as 9. That's very low, that's very complacent risk sensitivity. And our concern is that people can say, well, yes, the market's come down a little bit, but you still have a very low VIX, things must be okay. And I think the underlying signals show you there is still this potential for volatility. It's one of the reasons we do what we do in this hedged equity fund that we run. We really believe that even if the market is solid, there's still a chance for a lot of cyclicality on volatility as you get some of these news data points. I'm not even talking about our unorthodox president. I'm even talking about things like the Ukraine, Russia, earnings numbers. You see some very big numbers today in terms of names like Palantir and NVIDIA that are somewhat surprising. And because of the concentration of the indexes, the S&P and QQQ, those have very big volatility impacts. So we really think investors should make sure to have some exposure to products that manage volatility in this environment. Even if the market is able to muddle through, it looks to us like the implications of all this is volatility is going to be quite quixotic and changeable.
Yeah, and Chris, I think part of this as well is it needs to broaden out so that some of that concentration risk is mitigated. And the question is, okay, we have this fabulous AI story. Where would we have been if we didn't, if that wasn't part of it from November 2022? Where are these plays or the derivatives of that, right?
There's always something that's going to move the market, always. And whether it's a 2-year cycle, 4-year cycle, blockchain, you go back and pick your poison, right? Cannabis stocks a decade ago, right? There's always something that's going to be market moving, that's going to be the new hot child, that's going to see money inflows into it in a rush, and really without a credible valuation. AI is different. You're looking at spend across the board. You're looking at headcount somewhere down the future. It's going to be reduced. You're seeing less college graduates and new hires coming into the marketplace. Companies aren't ready to get rid of people. You're seeing small headlines here and there because they don't want to lose that expertise, because we're such an infantile story right now in the AI process. The question then comes down to shifting gears before looking at the investments. You've just opened up a whole nother category of investments, especially in the 401k business right now. Will that actually work out? We have to wait and see. But when you're talking about the 60-40 split traditional, you're seeing a lot of people put money to work in crypto. And Bitcoin is the big winner there. You're seeing a number of ETFs starting to list based off of tokenization, ETF. So there are other investments that continue to come out. Nasdaq alone, we've seen, I think, 800 ETPs list over the last year plus. So there's an appetite there for alternative investments continuing. The question is which ones are going to survive and which are not. And then to flip it one more time, we're talking about the diversification of the larger indexes in the companies. You're seeing breadth get much, much better in the small and mid-cap names, significantly.
And Maddie's our small cap expert, and that's what I wanted to ask you. We started to see some participation there because, outside of the Mag 7 AI story, certainly these companies can benefit from that as well.
Yeah, we got a taste of a small cap story last week after the CPI day. The Russell 2000 rose 3%. We saw about 1,700 names close up. We did see a sharp reversal once the PPI data came out. 1,700 names actually closed down the following Thursday, and the Russell lost about 1.2%, but it still managed to hold on to some of those gains. And so I think the story is, for them, they're data dependent. They are relying on more certainty when it comes to rate cuts. So they'll continue to move with the data, as Chris mentioned.
It's a really great point. You have to think about positioning and how people manage portfolios. People manage it in these very large cap names, and they have a relatively low beta. A lot of these large cap names have a lot of cash, and so they seem less risky. So now you look at these highly valued names and you say, okay, I need to sell some because, Palantir, I made 8 times my money in 2 years, okay? Well, what are you going to do? So you take a name that's a very big cap name. You're not going to take, let's say you sell 100 grand, $100,000 of a name. You're not going to plow $100,000 into small cap because the beta of small cap is very high. So you have to beta adjust. And so I think what the market has to be careful about when we talk to investors is be careful what you wish for because you might get it. If you sell a lot of these big cap names, you're not necessarily going to get breadth right away. You might incrementally get breadth. And so that goes back to my argument, which is when these regime shifts occur, volatility is the product of the reaction. And I think that's, even if the Fed lowers rates, which I think is going to be good with the financing walls coming for the small and mid-cap companies, it's going to take some time. And so I think investors should be forewarned. Yes, position for that, but just do it incrementally and make sure you have a volatility exposure, because if you don't, that process can be somewhat painful.
Yeah, and I'm glad you brought up that nuance, because from a fundamental perspective, you're looking at prioritizing domestic production, electronification, deregulation. Your first inclination would be like, oh, that sounds like a small cap play, right?
It can.
But bringing in that portfolio, addressing the mechanics of that is key to understanding, well, okay, these fundamentals look good, rates are coming down, why are we not seeing the money flows there? And I think that's a great point.
Well, part of it is also, as we were talking about before, there is a refinancing wall. And moving rates from 4.25 to 4, and 4.25, and 4 to 3.75 may not quite do it. And because of this unusual inflation, tariff construct, not sure exactly where labor, unemployment doesn't look like it needs a lot of drop. The Fed may be a little more constrained in how much they can ease. They may not be able to ease 150 bips. Yeah. If they can't lower rates 1.5 or 2%, what's the true benefit to small cap borrowers? Those are the kinds of questions that may change the results of this cocktail. And we also see some sector differences, because some of the sectors you might usually like to go to in small cap value may not quite get the same impact in this cycle. And some of the small cap growth names and mid cap growth names have already seen the increase. Look at the independent power producers, like those valuations are already quite high. So are they going to get it's hard necessarily to pile into those names at this point in time. So you have to be nimble, and you have to understand that this regime may not look like the past regime, which at the end of the day, we've had very docile numbers. We go back 15, 20 years, and yes, we've had some big downdrafts, but the Fed and the fiscal was always able to just prime. If there's any kind of impairment, because some of those factors are a little more impaired than they might have been in the past, what does that do to the traditional recovery?
Yeah. And Chris, the thing is too, if we were to get 1.5, 2 points, then you have to start asking yourself, okay, what's the bigger issues within the economy?
1.5, 2 points. That's a big swing. We're lucky if we see 50 bips.
I agree with you.
Right.
I agree with
you. But even so, let's say over the course of 12 months.
Right. Over the course of 12 months, right? I mean, say we get 50 bips by December. That's still, a full point and a quarter lower than where we were a year ago, which bodes well for small caps, especially on the annual refinance for them.
It's better.
It bodes well. It's better. It's not great, but free money was great for them. But they, that's not going to happen again either, at least in the near term. Who knows what the next black swan is going to be?
But the question is, what is built into these numbers? So when you look at small cap growth, the expectations are 40% earnings growth next year. And I'm thinking, okay, how do they get to those numbers? Okay, onshoring, reshoring, onshoring can give you something, and maybe you were very troughed, but some of this is assuming some good interest rate that they're back.
Right.
Absolutely, and a lot of the small cap names are not impacted by tariffs. Many of them are here in the U.S., no supply chain issues, they don't have to worry about that. So that takes out a lot of that uncertainty. But again, the majority of companies, down to 40% of the Russell is, cash flow negative. So when you have that uncertainty, are they going to be making money next year? Are they only going to be breaking even because of interest rate adjustments? Do I really want to invest in that company?
Right.
Unless I know exactly what the business line is. So there's a lot of questions to go out about.
Which is why you continue to see that money rotated into the the names that have fundamental business and fundamentally sound balance.
There's trading, and there's investing.
Right.
And the comment, the point that we make to investors, it's fine if you go into a trade for a trade's sake, but the real long-term money needs a very compelling argument. And I think the mid to large cap tech area still has a pretty compelling case. There are some other sectors that have compelling cases. But when we look at that full rotation, we are concerned that it's hard to make the full compelling case. And I think that you can actually make a very compelling case because of that you want to have an exposure to volatility. Now it's interesting, there are a lot of these buffer funds and defined outcome funds have been one of the fastest growing areas in the market. We manage a competitor to those that is more actively managed, systematically more actively managed.
Right.
But those funds have grown tremendously because I think investors have caught this idea that, wait a second, there is likely to be more volatility, so I need to do something. We're not sure they're doing it the right way.
And that's the whole question. Vol on what index? Or where are you concentrated within your long holdings? Just because you have a vol overlay, whether it's S&P or the Qs, if your concentration isn't there, it's not necessarily going to help you.
Well, here's the funny thing. If you own the S&P and you own the Qs, you almost own the same thing.
Right, right.
And so the way our approach is managed is we just use the index, the S&P, and then we buy a put spread, we over-defend a put spread, and we sell a call.
Right.
And this gives us upside participation, and we defend very tight so that the second the market gets into 1 or 2 standard deviations of losses, we start to harvest gains. And it's this idea of harvesting volatility, selling it when it's high and buying it when it's low. And that range, it's kind of like, it's kind of like a clipping mentality. Most of the funds don't do that. Most funds just position here, put the trade out 3 months, and they don't really get the benefit of the market move. The way we like to look at this, because we do believe there's going to be cyclicality of volatilities, we like to have shorter trades, 4-week trades. So we think these micro cycles are actually the way to play the market. It's more the trading, it's not so much the investing. And if you went back 2 years and said, because you had every reason to say it, breadth is the way to go. You gotta go breadth. You did that trade 2 years ago and you kept doing it, you'd be the most unhappy trader ever.
You wouldn't be around.
You would, if that was your investment. But if you trade around volatility, you'll see it's a tremendous, in this environment. It may not have been as much 5, 10, 15 years ago, but I think in this environment, it's a very good trade.
Right. That makes total sense because the way the market has moved right now, volatility is the name of the game. And whether it's being driven organically or if it's being driven from headline news out of the White House or where have you, stocks are reacting. And the more they react, the more opportunity there is for traders to jump in and take advantage of it.
Right.
Yeah. And Maddie, to wrap up here, anything we can see from the IPO pipeline in terms of anything broadening out there?
Yeah, well, I was going to mention, I think the IPO pipeline can give us a good inside scoop into, maybe what sectors will continue to be attractive, maybe what sectors will come up as more attractive, but we do have over 220 companies on file to list here in the US. SPACs are not going anywhere. We're going to continue to see that tech theme, AI theme play out. We do have a lot of industrial companies coming in, and we've already seen a few large cap industrial IPOs so far this year perform really well, so we do expect that to continue. Healthcare names are coming back, biopharma. But that said, we're expecting a really healthy IPO market for the rest of the year and heading into the new year.
All right. Appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.